So today's session is going to be on Benjamin Grant's security analysis, part one. But I kind of wanted to start by maybe just going back and reviewing some of the things we talked about last time, which I know, some people couldn't make it, and I guess what I'd like to start is what are we trying to accomplish? Because I think it's easy to get kind of caught up into the minutiae of what he's writing, or kind of being really good at coding, which is not the goal, because there's no extra credit for precise quotes. Anyone can do that. I guess the way I think about what we're trying to accomplish is we're trying to come up with our own investment process that's based on our own strengths and weaknesses. So we're basically not trying to take a proven approach that works, we know works, because if we start completely from first principles, we're going to make a lot of mistakes that we can avoid by starting with a sound foundation. But then we want to be aware that we're unique people, and what works for me might not work as well for you, and vice versa. So I guess I like to think about it. There's three things that we're trying to do here, and the first is understand. So I think it's fine to disagree, and actually it's encouraged to disagree. But if we don't actually understand what's either Ben Graham or Warren Buffett or Phil Fisher is saying, we're not disagreeing from a position of knowledge. We're disagreeing from ignorance. So the understanding probably comes closest to when you're quoting stuff, but it's not really just quoting; it's understanding what he means. And I think of myself as kind of a Sherpa. I'm not here to teach, but I'm here to guide you guys, and to maybe push back. And there are things I don't know. Like I don't think there's a single person, maybe Warren Buffett and Charlie Munger are exceptions, but even they, who knows absolutely everything. So it's kind of a learning journey together. The second thing that we want to do is apply. And investing is not a theoretical endeavor. A number of you had good questions. Thank you for those who sent them in. It's not kind of being able to say, oh, I understand the theory. There's this intrinsic value thing. I do this and this and this. But then you get the specifics and you can't apply it, and it's all in the application, right? There's no benefit to just knowing the theory if you can't apply it. And the third thing we want to do is customize. I talked about strengths and weaknesses. So I think sometimes people get stuck in the replication stage where they become really good, like students who are famous investors, let's say Warren Buffett, and they go around and they quote Warren Buffett and they do everything like Warren Buffett. The problem is they're not Warren Buffett, and they don't have the same setup, they don't have the same strengths and weaknesses. What might have worked 20 years ago might have changed in some ways, and that's one of the topics for discussions. How have things changed, or have they changed? What's timeless versus what's specific to a context? So I think people who get, and by the way, they're pretty advanced investors who are they're stuck in the the replicated approach, and I think it's not that it's bad. It's better than just doing random stuff, but it's certainly not optimal because they're different people. So I think customize is going to be important. So I think you kind of want to zoom out as you read this. You want to figure out what is he doing and why is he doing it, and then how is he applying it. Then we're going to have examples that we're going to use. Some we're going to just pick stuff that's current that I don't know the answer to. Maybe you guys will help me with that stock of mine that didn't do so well last quarter. We'll figure it out together. So, but some of it we can just do kind of stylized examples just to illustrate a concept. So in part one today, we're going to mostly think about conceptually, right? Because I think this is kind of the foundation for the rest of the book. And I think there were three questions. I remember them. I don't remember the order. So who remembers the order? I think, what was number one? Otherwise, I'm going to have to look. Yeah?
What's Ben Graham's approach, and why does he think it's the optimal approach?
Yeah. All right, I just tricked you into volunteering. You don't have to, but if you want to, sure, go ahead.
Sure. His approach was basically to build, I can't remember exactly, but one part of it is, like the answer I gave, he wants to build an analytical approach, but also a systematic approach. So he constantly talks about the facts and also about standards.
Okay.
It's kind of the two tenets that I got from his approach.
Right.
The reason why that he thinks that the optimal approach is because from that standpoint, it's the only logical way to invest.
So I heard analytical, I heard standards. Okay. And that's important. So I think, it sounds like what else could it be other than analytical, right? But You won't believe the number of times people, like serious investment professionals, decades into their career, say, "I just have a gut feel it's going to work," or "it just feels this." And some of them might mean that it's basically a heuristic for experience, a kind of a pattern matching, like the same way kind of a chess master might look at the board and say, "The board calls for this move." But I think a lot of times it is like they're guessing, and so I think analytical is an important distinction. And standards, I think it might have been you who wrote in your answer that kind of standards identified in advance, right? That you lay out a set of standards criteria for decisions that then is going to allow you how you're going to make decisions, right? As opposed to kind of winging it in the heat of the moment. So that's good. Anyone else? Thoughts on number one? Yeah?
So based on facts and not on speculation.
Okay. Facts. I know this is a dangerous topic in this day and age because sometimes we disagree about what facts are. But and that, by the way, can be true with companies. I don't think in Graham's days there was an alternative facts kind of movement, but there was definitely sometimes there's accounting, which is the language of finance, right? Which is how companies communicate what's happening to their financial position. But sometimes accounting can be subjective. Standards change. You see new standard applied, revenue revised or something like that. What that just told you is what used to be the truth, the fact, is now a different fact. Which fact is right? Presumably the new fact because a bunch of wise men and women of accounting got together and all agreed that that's what's going to be the new truth. But a year ago, we didn't know that, right? So there is some subjectivity even in accounting. There's less than in other things, so it's probably as precise as possible, but they're estimates. Examples might be you have to reserve for doubtful accounts, right? How do you reserve? Well, you have to have a process. So standards, that helps, but two very reasonable people can have somewhat different reserves. Like at what point do you say, man, that company's just not going to pay me. I have to write it off. So I'm investing in a company that has some receivables that are 2 years old. That's pretty bad. So what's the problem? Well, they have some Middle Eastern countries, some of them known for using chainsaws, or allegedly, I should say, allegedly using chainsaws on people. And these are the kind of people they don't like to pay on time. And what are you going to do? So you kind of have to work with them and wait, right? Now, but they do eventually pay, at least some of them. So now they're going to their auditor and saying, well, okay, we think it's good because they just paid us $25 million that was 2 years old. So we have reason to believe that the other $50 million is coming. Is it? No, maybe they only have $25 million to pay. I don't know. Maybe oil prices go down and that's their main source of revenue, and they don't have more to pay. That's judgment, right? So there's no facts. So, but they're as closest to the facts and assumptions. I think it's an important thing to make sure that we differentiate between what's a fact and what's an assumption, right? So kind of even in accounting. What else in number one? Yeah.
A big thing that stood out to me was when he kept talking about like the intrinsic value portion of his investment strategy, and finding companies where it's basically like even if they went bankrupt, their stock price would rise and you could sell at that point. Like, and you look at it like that, you can't really lose on the stock if it goes bankrupt, and you still could make money.
Yeah. So intrinsic value is interesting, right? Because we know it's a range. It's not one point number.
Right.
So it's both uncertain, meaning at a given point, like we're not sure what it is, but we can estimate it in the range, and it changes. So like a simple example might be you own 2 factories and they're producing some cash flow and they are worth X. And I don't know, an asteroid strikes the one factory. Just making it up, but some disaster happens you're not insured for, let's say, and that's it. Your value is lower. So it's not that you were wrong about the estimate. You estimated as it was, and now it's different. So the value changed, but then there's also so it's both uncertain and it's dynamic, which is why it makes it hard. So it's not, So I think it might have been you who kind of said, how do we apply this? How do we actually do it? Which is I like the way you're thinking. That is the kind of the thing. And so I don't know if we'll have time today to dive into the 10Ks and thank yous as you asked, but we'll definitely be doing that later. So not to worry, plenty of that coming. I think today what I want to do is set the foundations for what we're looking for, what are we thinking conceptually, and then starting with the next part, we're going to definitely dive into actual applications. Like how do we do it? Other thoughts? Yeah.
I think he said like what factors influence the market price for the
Okay.
security. And also, another question was like if you buy a stock with a 20% margin, is that like let's say I'm confident the stock should be $50 to $60.
Mhm.
I might bake in another $10 because that's my margin of safety. Is that what it means?
Yeah, so margin of safety. So I think that's that's a very important concept, and I think margin of safety. As you can see, handwriting is not my strength, as I told you last time. So I'll try to write as little as possible. So margin of safety is interesting because I mean the best way to describe it is probably as an engineering concept, right? You're like building a bridge; it can handle 100,000 pounds of weight. You don't want to say 100,000 pounds if that's all you can handle. You want to say 100,000 pounds if you can really carry 150,000 pounds. You want to leave room for error because if it's that precise and someone thinks they gained a pound on the way they ate some ice cream and the bridge collapses, right? You don't want to have that kind of really adverse event happen because of that small difference that you can't tell. So you want to leave plenty of room. So you don't want to leave 1%. How much? It's hard to know because I think it depends also. So the ranges of intrinsic value are not. There's no rule that says that they all have to be this wide, and that's one important. And when we talk about quality, to me, one of the things that determines quality is how narrow or wide the range can be, and that's a qualitative aspect of it, right? So is 20% enough? Well, if it's a U.S. government bond, yeah, I think it is. Unless you have if you think we're going to default, which it's possible, it's probably not a 20% chance. So if you have a treasury bill that's due in 3 months and it's trading at a 20% discount to par, that's probably more than plenty of margin of safety, right? As a matter of fact, if you find that, call me first. But if it's a really uncertain business, let's say it's a new company that's never earned any profits but it has an exciting business plan, and it's a separate question whether you want to look at that or not. But let's say you do, 20% is nothing. The range can be so wide that that's just not enough. So there's judgment. And that's my point. Is there's investing is not a formulaic endeavor where you figure out theory, you figure out how to apply it, and then you just basically, dogmatically do it. There's a art and a science that I talked about in the past, and the science is maybe knowing accounting, knowing how to calculate intrinsic value. The art is, judgment about what are the key inputs, how wide should the range be, where to fish, where not to fish. Those are some of the things. So I think it's a good list, and I think some of these are the the basics kind of ideas. And I think one thing that's important to keep in mind is why is he doing this? So who knows when was the book written? Not the 6th edition, but the first.
1929.
Right around I think it was in the early 30s. But you're right, it was around the Great Depression, right? And I don't know the facts for sure, so this is kind of here.
The first one was in the early 1900s, and then the second edition came out in the 1930s. Not that it matters.
No, it does matter because I think that would be interesting. Let me see if it says in here. So here I have first edition 1934. No. And by the way, that would be important. The reason it's important is what happened. 1934 was right after the Great Depression. It was still in the middle of the Great Depression, but basically what you had is you had a massive collapse in stock prices. And my understanding, and this is kind of the hearsay part, is that Graham lost something like 70% of his portfolio in the Great Depression. So I think one of you said, well, he has this intrinsic value approach that allows him to kind of be Teflon Ben. He never loses any money just because he knows how to use intrinsic value. That's just not the case. So I think part of it, he had this experience. Part of it is what happened back then, and you can see kind of threads of this throughout part one, is people used to start thinking that investing in stocks in general is speculative. It can never be an investment. The only thing that's an investment is kind of a government bond or a very high-grade corporate bonds, because they saw these companies, which in the Roaring '20s were, RCA was so radio was the exciting industry, it was new, and if you look at the stock chart for RCA, it was going the same way that some of the kind of current stocks like that. They're unbeatable. Nothing can go wrong. What can possibly go wrong with RCA? Radio penetration is low. Everyone wants it. It's going to be great. They're the leader. RCA stands for, I think, Radio Corporation of America. And then, a blue chip company like that lost a huge percent. I don't know how much, but between 50 and 75, or even more potentially, of its value. And lesser issues lost even more. So people kind of were shell shocked. Not to be morbid, but I think people were committing suicide because they're wiped out. They borrowed a margin. They went all in. They had nothing. They had nothing to go back to. One day they were kind of middle class, people happily investing and looking, saying, look, I made 20% last year. What'd you do? 18? Oh, and then all of a sudden they were down 75%. Or if they use leverage and margin, they were wiped out, right? So he's writing at a time, originally at least, where people are shell shocked. So this is the closest thing I've experienced. So I've done this for 18 years. Is 0809, where there's this whirlwind. Bear Stearns almost goes bankrupt. Then the next one, who's next? Lehman files. Everyone's guessing, is AIG going to file? Is government? So nobody knows where the bottom is. By the way, this is an interesting point. I answer people's questions a lot, and on Quora and other places. A common question is, how do we know if it's the bottom? And I always joke that a well-dressed man comes out, with a tie, rings the bell, and says it's the bottom. It's safe to buy securities. Go ahead. Well, obviously, that doesn't happen that way, right? But the whole point is nobody knows when it's the bottom. And during a panic like the either financial crisis or the Great Depression, there was no bottom. People got because people in 1929, there was a famous, I think Irving Fisher or some famous Yale economist just said there's a permanent plateau of prosperity. We have new standards. We don't know, old standards don't apply, variation, and then people get wiped out. So, when stocks first fell, people bought, and they fell more. They bought more, and then the bottom was far, far below, and many years away. So anyway, the reason I got into that is I think it's very important to understand that even a very sound practitioner can lose money, but more importantly is he is talking to people who lost faith that this is actually a scientific and analytical endeavor. They basically think this is gambling. Forget about it. So he's writing this as a counter argument, saying, no, wait a second. There's a way to do it, and the way is security analysis, and that kind of is why he's so focused, at least in part one, on the difference in investing and speculation. Because right now everyone is saying all of this is speculation. Forget about it. It's gambling. Don't do it. What was question 2? Who can help me out? I won't trick you into answering if you don't want to. Go ahead.
Which parts of his approach would you want to imitate? Which ones do you think you would rather not, and why?
So what can we cross out here? Well, we don't have to. I mean, jokingly, there are definitely things that you're allowed to disagree. Not only are you allowed to disagree, it is part of your goal to figure out how to customize what he's doing. And part of it's saying, you know what? I want to do something differently, or I'm not sure if I want to do it. That's another way, because the less you know, the more you want to be tentative. The more you know, the more you want to be confident. So I think if you're not sure, you can say, well, there's a question mark next to this aspect. So that as you read through the book, just think about where the question marks are versus where the exclamation points are. Like, yes, that definitely resonates. Versus like, maybe, or maybe I don't understand, or whatnot. So anything stand out as far as what is not something you want to replicate?
I really love his way of analyzing the stocks and having his own standards and having this analytical framework. But I think one of the things that I'm going to struggle with is the time to put in. And so I suppose what I'm really seeking from this course is understanding enough where my framework I can kind of operationalize as I look into my investments, even if it isn't my whole world. And then to go to one of my questions that goes with this is I think a lot of times when we don't have a lot of time to look at our investments, we think indexes are a really great way to go because we diversify. But in the book, it does specifically mention that those are not necessarily the most prudent ways of, or prudent method of investing. So I know I just threw a lot on you.
No. So one thing I want to clarify. So we're reading the 6th edition. So 6th edition is basically the original edition, or 2nd edition, or some version of it, plus commentary from about 10 years ago by a bunch of value investors led by Seth Klarman, who's here in Boston at the Baupost Group. He's kind of the senior editor, and he picked a few other well-known value investors who had specialties. So there's stuff in there that's contemporary. By the way, that's intentional, it's contemporary. Part of the question that they're asking is, how relevant is this to today, and what would you change in today's environment? So each part is accompanied by kind of a modern day commentary, and then there is, this is not meant to be religious, but it almost reminds me of kind of like rabbinical commentary. There's like the Old Testament and then there's modern day people saying, what does this mean? Is it still useful? How do we, can we turn on the light? Not turn on the light? Can I turn on the light? And the different interpretations, right? I'm not going to get into some of those details. But so this is kind of, so I think, I'm not sure if what you're referring to is in the comments. Do you think the index part, I'm happy to answer, do my best. Was that in the commentary or was that Graham?
That was in the commentary.
Okay, this is because there were no index funds back then. That's why I wanted to make sure I clarify, because back then, and so I think index funds really got started, I think, in the 70s when John Bogle started Vanguard. But let's talk about index funds. I think, so my view, and this is not a common view among active managers, that most people, well, pretty much everyone should start with it as a default, and then look for reasons to deviate. And those reasons are infrequent, or not many people should be deviating.
Starting with the index as the default?
So you should say your default position is you can't beat the market, because there's enough evidence that's very difficult, right? And your default position is you can't identify a priori those who can beat the market, right? So because so back to my kind of preview talk there was active management, which is trying to do better than the market, and then there's passive, which is trying to replicate the market or portion of the market or something like that. So in active management, right, you can do it directly, security analysis, which is what we're talking about, or you could say find someone else to do it for you. So the reason I think, again, I see this question a lot, it gets asked all the time. I have X $1,000. How should I invest? I usually send them links to 2 books: Benjamin Graham's Intelligent Investor, which is kind of a layperson's version of this, and then a book by Burton Malkiel called Elements of Investing. And basically the punchline of that book is, plan your finances, invest dollar cost average in an index or a couple of index funds, and just save, a fair amount, right? So why? Because this is really hard. And most people, beating the market is a negative sum game, meaning that on the sum of all the deviations of all the participants will be 0 before expenses and frictional costs, and after it'll be negative. And empirically, we know that. If you look at the Vanguard 500 index fund over like a 15-year rolling period, it beats after taxes something like 85% of investors. So why are so many people still inactive? Well, because remember behavioral biases. We all think we're above average, right? Second is people say, well, I can identify people a priori, so I can go into Fidelity or T. Rowe Price and find the experts who can be in that 15%, even though I know the base rate probability, the likelihood, if I'm just drawing blindly from a earn, is low. The problem is people are using the wrong rule of thumb to do it. They're looking at short-term trailing performance. And they're saying, if the manager beat the market the last year or 3 years, I'm going to pick that one. And the industry does people no favors because it markets that way. And it's very cynical. They know that means nothing. There are studies that show there's no correlation between one 3-year period and another. So there's no predictive power if you take fund managers and divide them in cohorts based on 3-year trailing performance. It doesn't predict the next 3 years. But nonetheless, the industry cynically takes out ads in the Wall Street Journal. Look at how many stars I have. So I don't blame people, but the thing you have to ask if you're going to deviate is, can I approximately judge the process? Can I judge the process? Do I understand why this person and this process should be superior? So I think Ben Graham over time beat the market. So it's not all hopeless. It's not like nobody can beat the market. When we talk about Buffett, there's a famous speech he gave in 1984, which is called "The Super Investors of Graham and Doddsville." And the point of that speech is that look at the people who have beaten the market are predominantly value investors over long periods of time. Not only that, and his punchline is, well, you might think they're just lucky, maybe, kind of like monkeys, flipping coins in a zoo. But what his kind of punchline is, well, what if I told you that all the monkeys who keep flipping the right way are from one zoo? Would you kind of be saying, maybe the zookeeper has something to do with it, it's not just random? He says, well, what if it was just, they were all picking the same stocks and it just, and he shows that people use the common philosophy, value investing, and picked very different portfolios, and as a group they did extremely well. So anyway, so I don't want to get completely off kind of part one, but the point is, there was a small minority of people, which by the way, how I started as a value investor 19 years ago, is I started with what works, like what has a track record of working, and value investing definitely has a track record of working, and then what appeals to me. And now I'm an engineer by training from MIT. I like analytical standards, facts. Those are things kind of play to my strengths. But there is evidence that it works. Yeah.
Oh, sorry, go ahead, finish your point.
No, but I think it's very difficult. So just I would say unless you really study and have the right temperament and have the time, I would say index is a perfect, good way to go.
Mm-hmm. Kind of echo off Alexandra's question, or piggyback, I should say. As value investors, how should we be sourcing our investment ideas? Do you recommend like a type of research? Like, where do you go to find the next best thing in your opinion?
Right. So I think it's important, to not have a monoculture of how you source ideas. So, like the obvious way is you have screens.
Mm-hmm.
The benefit of screens is that they look at a lot of things quickly, and they're objective. At least they're there's standards based, so you can quickly set up a screen in Bloomberg and whatever mechanism you have to say I want securities that have these characteristics. The problem is a lot of times those are characteristics that everyone else is looking at. So in this day and age, there's a lot of computers, and you're not going to have the biggest computer, and so I think it's fine to have that as a starting point, and the kind of scientific foundation for that is that low, statistically inexpensive stocks. By that I mean stocks with low price to earnings ratios or low price to book ratios have on a rolling basis over many time periods outperformed the market. So you're drawing from a positively biased universe, right? So at least the odds are on your side. The bad news is the margin of victory is small. There's some argument maybe it's getting even smaller. I mean, the margin of victory for like the cheap stocks or the value factor is about 1.5% to 2% pre-fees, pre-tax, pre-everything. So if you were to just blindly do that, after you all said and done, you're not going to have a big margin of victory. But you're probably going to do better. That's my belief. And the Brandeis Institute has a study of rolling 5-year periods across market cap and geographies, and I can share that with you, how the value factor works across time and across place and across stuff. So that's the kind of the easiest. So the three other things I like to look at are special situations is one. Now I have a friend who says everything I own is special, but I don't mean it like it's special because it's my pet stock. I mean it in a sense that there's a reason for either neglect or forced selling, right? Because you're kind of thinking like, what's causing a mispricing? So either no one is looking, or everyone is looking and hates it. Mm-hmm. So that doesn't mean that everything that's hated is a good investment, or anything that's neglected is a good investment. But it's a positively biased universe. So some examples will be spin-offs. So a company might be a large company, has a small, less attractive division. It spins it off. Let's say the parent company was in the S&P 500 index. A bunch of index funds and a number of active investors masquerade, hugging the index for business and bonus reasons, get this little piece of, nice new security that's not in the index, that's much smaller, and that's different than what the parent does. A lot of time, let's say they had a 1% position, and they might get a 0.05%, 5 basis point position in new security. What are they going to do? They're going to sell it because, why bother? Because are they really going to make it a meaningful position? It's not on the benchmark, blah, 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 blah. So a lot of times they'll be forced, just giving you a classic example, they'll be forced selling. All these people are selling for non-economical reasons. So it's not that they went through this and said it's overvalued with selling. They're selling regardless of value. So you want to have so whenever people are doing something regardless of value, if you are a thoughtful student of value investing, you can potentially find opportunities. Which, by the way, again, not every spin is a great investment. It's just a positive universe. Another one might be really small stocks, companies where most institutional investors can't or don't want to follow them, right? So as someone's assets grow, they can't go and they can't invest in $200-300 million market cap companies. So there are fewer analysts, there's less competition, nothing is happening for a while, and sometimes they're less efficiently priced. And then many others. There's reorganizations, there's post-bankruptcies, there's asset conversions. For instance, to give you a live example, there's a company, I don't know, I looked at it, I'm still thinking about it. Ticker is TPHE, Trinity Place Holdings. What it is it's a bankrupt retailer. I don't know if anyone's heard of Sims, SYMS. You guys all buy on Amazon, I know. So, but I'm probably older than at least some of you, and I've used to see it in New York. So it's in New York. They used to have a big box right by Wall Street. Company went bankrupt. What Trinity Place is they have this the big box, and they're converting it to luxury condo. It's right by Wall Street. I went to high school, Stuyvesant High School, which is right there. It's completely supply constrained. It's Manhattan, and the prices there through the roof. So they have this. It's basically a resource conversion. You had this retailer, it's failed as a going concern, had a valuable asset. The bankruptcy process erased old liabilities, and now they're basically converting into something new. It's not going to screen well. Well, why is it not going to screen well? They have no earnings. They have no history. But you know that the real estate is valuable. You know that, we know, for instance, they already have the city as the anchor tenant. They're going to have a school at the bottom floor. So we know what's happening. So now the question is, what is it worth? And so why, why it's an orthogonal, meaning an independent supplement to looking at screens, because it never come up on the screen. There's no, its book has been written down. It's what you have to know where to look. Another, so that's the second source. Another, my third source is I have a list of what I think are high quality businesses. So kind of a watch list. It's a pretty loose list, about 500 companies. Some people like to have these are really amazing companies that I know well of 50. I like to have a little wider list kind of within my universe. Some of them I know really, really well. Others I just know enough to know I think they're pretty good. And I look for dislocations. But by that I mean something where all of a sudden, let's say the stock is down 20%. And by the way, these are really good companies, so it being down 20% doesn't necessarily mean the stock is now statistically cheap. But I know it's such a good company, it's probably worth a look. So it's kind of a watch list. I also have a subset of actual inventory of companies that have a value range on, right? That's a much smaller list. I'm human, I can't, have value range of 500 companies. But it's about 40 companies right now, probably going to be 50, which is a steady state, where I have an active value range. Like if the price changed today, I could buy it. There's very little additional work.
So is that across sectors?
It is across sectors.
Okay.
It's not in every sector. I mean, I'm a microeconomics person, so I don't, I try to avoid situations where the question is about, what's the government going to do? What's oil price going to be in 10 years? I try to focus on, competitive analysis, microeconomic questions. That's kind of my area of expertise. So, but again, going back to customize, that doesn't have to be yours, so you might figure out a great way to invest in energy companies or something else, or you might be really interested in regulation and understand how politics will influence business values. I know I don't, so I customize it to my strengths.
Yeah.
So that list, and then lastly, I like exchanging ideas with other value investors. Sometimes that's frowned upon. When you're talking to potential clients, like, what do you mean? You use other people's ideas? Like, isn't it there is no pride of ownership. I'm not buying things because someone tells me they're buying it. I have a group of people I respect whose process I gotten to know that I think, to me, if they're investing in it, it's worth understanding why. And does it fit my own? So, and again, a lot of times these people are looking at somewhat different niches and whatnot that, again, won't show up on the screen. So, long-winded, but it's an important question. You have your standard bread and butter screening, kind of easy to do. You can set it up. You can look for various metrics. Then you have special situations, usually event-driven, kind of forced selling, neglect. You have kind of in my case, a high-quality watch list, kind of my wish list of what would I love to buy at the right price. And then finally, kind of exchanging ideas with other thoughtful people whose process I know is to be compatible with mine. So I think together they complement.
Does it tend to be like former colleagues or just people in your network?
No, people in my network. I mean, well, so there's two groups. There's the people I actually talk to, like live, like I pick up the phone and say, hey, what are you finding opportunities these days? And we'll talk. They're idea conferences, so I'm going. I'm sure it's going to remind you we're not having class next Friday. Let's give you one. I'm going to be unusually for me in Switzerland, and this Manual of Ideas is an organization that's having Idea Week conference where value investors hang out. And, some ski. I don't ski. My wife's going to ski, so she gets to ski while I talk about stocks. So everyone's happy. I'm sure you're all thinking, why would he not want to talk about stocks when he's skiing? But basically, so that's kind of a in-person kind of event. There are virtual events like that, and then there are just investors I respect who I don't know well personally, at least well enough to pick up the phone and have a conversation, but they're filing. So over, I think about 125 million or so. If you're managing more, you have to file 13F. It's a -HR, and it's SEC.gov. You can basically, on a quarter lag, find out what anyone owns, up to a point. It's for long, you don't have to report short positions, but I don't short anyway. So whether they want to or not, they have to tell you what they own. Now, by the way, that's probably my least favorite source of ideas, because let's take a great investor. If they're managing $30 billion, their best idea might not be awesome because they're managing so much money, they're forced to look at more widely available opportunities. So I think a lot of times I would say that's probably the last place. I'll still look because I respect that they have a great record, they have a process that's compatible, but I'm much more interested in what someone managing smaller amount, because what I would love to know is what would they be interested in if they were managing a small amount of money, but they don't have to file that because that's not disclosed.
Right.
So you kind of get selection bias that they're only investing in 5 billion market cap or above companies, but at least many of them are. Does that answer your question?
Yeah. I have another question, but I can say
No,
that.
you're allowed.
No, I
There's
feel
no
bad, I'm,
quota.
hijacking this.
No, you're not hijacking. We have plenty of time. We're gonna get. We're already 2/3 of the way through. No, I'm kidding. But ask the question.
As an individual investor, I really do believe in getting to know the management teams and understanding their strategy and what their competitive advantage is. Now, obviously, as an individual investor, it's probably harder to get to know the management teams or kind of maybe get access to them. Do you find that true versus an institutional?
Well, so I'll answer through my own experience, and then I'm going to get back to Graham because I don't want to,
Yeah.
I don't want to make it about Gary because Gary's not that interesting, and I would take Graham over Gary anytime. But so I started Fidelity, where you have access to everyone,
Right.
even the Almighty has to answer it.
Yeah.
But literally, I remember being a 22-year-old analyst, and the CEO would be grinding his teeth by answering my question. True. Why does Fidelity have a new idiot? Gary asking me the same questions at 12 months ago, because he used to the analyst 12 months, just to infuriate management teams. They just got to the point where someone knew just a little bit not to ask stupid questions, and now Gary comes, right?
Yeah.
So it was a great school for me. So you get that level of access. Then I spent part of my career at kind of mid-sized firms. By mid-size, I mean maybe they're managing in a 30 billion to 100 billion range. They're kind of in that second tier of size where you might be in a group meeting, you might not have the one-on-one, or might be, but and then now I manage very small amounts of money. There's no size. I'm closer to an individual investor in terms of size of most companies. Well, here's what I found. At the mega cap level, I'm never gonna have a one-on-one with a CEO unless it's one of the people I have an existing relationship with,
Right.
which I have some, but it's not 500 relationships. Right? There's some companies I know well, and I visit them one-on-one every year. They're not doing it because of my size; they're doing it because they respect me. We have a 15+ year history. But that aside, even those companies, I think the IR department is going to be very accessible. A lot of the bigger ones have kind of an IR team. They have the senior IR, some of them are rotating it, kind of a stopover to learn other parts of the business, and they're going to go back, maybe be a CFO of a division or something like that. So they're actually not that junior of a person. They're kind of a mid-level person, and they might have a couple of people under them. So I think you'll get to someone if you try. I'd be shocked if you don't. And actually, I had a situation. I'm not gonna name the company, but there was a large. I'll give you an example. A large company, very large one, that I owned an investment in, and had an analyst day, and investor day, and I figured it was a large position for me, even though I was not a big holder just by virtue of how big the company was versus the size of the assets I managed. And so I emailed IR a generic address because I figured, I could have gone directly to someone else because I knew some of them, not directly, but I knew who they were, and I have friends who have their personal email, their direct emails. So I'm just gonna go through the front door, ir@company.com, say, hey, I'm a shareholder. What I always like to say is, I'm long-term, I'm fundamental, I don't short stocks, so I'm not coming to you, if you tell me the wrong thing, I do one thing. And the reason I tell those things, it's, good companies should want people who are long-term patient shareholders. My average holding period is in the 3 to 5 year range. The average holding period is less than a year. So I guess, sell myself to companies as, hey, by the way, people differ on this, but I typically don't call management until I've done a fair amount of work.
Right.
I'll have read 10, 15 years of annual reports, done the 10K, maybe built a quick model. There are other people, and I tried the opposite approach, which is like, hey, just do a quick 30-minute thing and then have them teach you the business. And I'm just very uncomfortable with that. Plus, also, I think it's disrespectful of their time. You kind of like are coming in and saying, hey, there's all this publicly available information, but I'm so important that you should just teach me anyway because I'm Gary and here, right? So that's not and I also say, look, I already read everything. I listened to all your conference calls, so I'm not asking you to tell me what you do. I have a few other questions that I wanted to address. Would you mind doing a conference call? So in this case, I just wanted to participate in this public. It wasn't a semi-public event. It was a limit, but I figured, hey, who better than a current investor, owns a bunch of stock already, so forth. No response. A week passed, no response. I had lunch with one of my friends who covers them was a junior analyst on my old team. I said, well, give me the real email. I'm going to try it again because I'm going to give him the benefit of the doubt. Because plan B is I'm going to email the CEO directly, and I don't want to make the IR look bad because I'm going to go to this meeting.
What's IR?
Investor relations officer.
Oh, sorry.
No, that's a good question. I shouldn't be using jargon if I'm making assumptions which are not warranted, and that's my fault. But so finally, I get a generic response after 3 or 4 weeks, and I leave a voicemail. Sorry, we are full. I'm like, So I emailed the CEO directly. I said, we'll call him John. It's not his name. I said, John, I'm long term, whatever, and I'm going to assume it's my mistake because I'm having a hard time getting through. I'm going to assume I'm just emailing the wrong email address. Would you connect me with the right person? Because I'm pretty sure you'd want someone who's, long term and as an investor at your investor day. The investor having the day for. And I said, look, in my 18 years of working at large firms, I've never had this happen where they're just not replying. So I'm going to assume. And within 4 hours, I had the the invitation and all was set up. It shouldn't have, but that was a shame on them. That shouldn't happen.
Right.
And wasn't my goal to cause any trouble. But at the end of the day, I feel like if they're having a kind of event like that, you can, especially if you own the stock, you can get in. I mean, and the next best thing is you can probably listen on the a lot of things are transcribed. So that's the follow-on question is a lot of times you can listen to a replay, read the transcript. And finally, with smaller companies, especially as a value investor, frequently I'm engaged where there's some problem and they're not the most loved company. Something is not going well. The stock is going down, and that's usually when I'm interested more often than not. Not always. There are different times. So they could use some friends. They're kind of a little lonely. People are telling them, oh, you're doing all these things wrong, and here's a new investor who doesn't have any biases. I find that frequently I'll get to talk to someone. Sometimes it's the CFO, sometimes it's the treasurer. For a lot of smaller companies, the CFO is the investor relations officer, so they're not big enough to have a separate department. So I find that you can get access. I also find that access is overrated. I mean, in the days before Reg of D, so Reg of D, not to use jargon, is in 2001, the SEC passed a regulation called the fair disclosure, or full disclosure, I think it's fair disclosure, that basically anything that, material that's told to one investor has to be, released to everyone, right? Which, by the way, before, when I started Fidelity, used to be like, you pick up and say, hey, starting in 2001, right before, how's the quarter going? Oh, right, and there was a lot of PMs and analysts who played that game. Who's going to beat the quarter? Our researchers calling the company, CFO, and saying, hey, how are you doing in the quarter? Oh, better than expected. Awesome. Right? So Reg of D said, you can't do that. It should have been obvious, like you can't do that, but it's kind of like, okay. Now they had a rule, so now people had to be a little bit more circumspect. But so when I talk to the management team, I'm not trying to figure out what's happening next week or what the quarterly trends are. I'm trying to figure out things like competitive strategy, capital allocation, culture, things that, or specific things that are clear to me. So I'm not asking for like a handout on some data point that's going to move the stock. I'm trying to understand the business as if I'm investing in the business, which in my view I am, not in the stock. So anyway, good question. But let's go back to, let's do question 3, because that's kind of the, I think the meat of at least what I wanted to talk about today. So who remembers question 3?
What's the difference between an investment and a speculation?
All right, let's do it. What's the difference? Who wants to do it? Yeah, we got a volunteer.
I'd say an investment takes like actual analysis and a thought process on why you believe it's gonna go your way, and speculation's more like you were talking about, like that feeling, or you've seen it and you're just like, oh yeah, it worked once, like it'll work again, and you don't actually do the research on it.
Analysis, okay. I feel like this is like playing hangman. But let me. I'll read. I had a couple of bookmarks because I know there were some questions that I bookmarked. But this one is probably one of the better quotes. I think one of you pointed it out as well.
Is it page
106? So on page 106, an investment operation is one which, upon thorough analysis, that's why you get the hangman credit, thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. So there are 4 things in there, so we don't have to play hangman. I'm just going to put them down, but we're going to talk about what they mean, because it's not clearly obvious what they mean. And I think they're intentionally broad. We'll talk about it. So there's thorough analysis, safety of principal. Really have to check, this is a spelling test. Which principal? Principal. Good thing. I was gonna write it the wrong way. You're next. I'm just gonna finish writing down. Satisfactory return. Return. And one that people usually miss, but I think to me is one of the most interesting, is investment operation. Investment operation. So let's go. You had a question, and let's do the question.
I think he said that like a speculator, like he knows of the risk, and the investor, like he doesn't know of. Not doing it justice, but like the investor takes the risks into consideration, and if it's an unforeseen risk, like that was.
So deliberate, like understanding what can go wrong versus just being oblivious. I think that's. I would say, yeah. I think that hits a couple of these categories. So both safety of principal and satisfactory return. Yeah.
I think a way I've seen it being phrased when it comes to risk is that, especially when it comes to like hedge funds or traders, an investor kind of tries to minimize risk. Well, a speculator actually welcomes risk. They know a lot. Actually, the best ones know what the risks are, but they think they can handle it better than you, and that's why you pay them.
Interesting. So when you say they want risk, like tell me more, because it's not like they come in and say, "Yeah, I would love a chance to lose a bunch of money." That's not. And nobody wakes up unless what? Why would you take on that risk?
I've seen the example I think of is there's a lot of hedge funds in the early 2000s. There's a lot of hedge funds in the energy industry. One that blew up, but for like 1 or 2 years, they were really good at trading futures on natural gas because they had not some inside information, they just had better models. They had a really good trader. He's the one that ends up blowing them up, but they had a really good trader that had a hot streak. And so their perspective was that we can handle this risk better. And our company Chevron, I don't know, like someone wants to hedge those risks, we'll sell the futures. We know that we'll make money.
Right, and so I think sometimes, I think this is interesting. The interesting question is, so I think to your earlier point of standards, he sets out criteria that are a priori criteria. they're not after the fact. Like if you lost a lot of money, that means you were speculating, right? That's not what he says. Or if you made money, that means you were, right? So it's not outcome based, it's process based, which is one of the things, I think one of the hallmarks of a good investor is someone who has a clear process that they're following. Because the point you just made about some guy trading futures for a couple of years with a hot hand, that's exactly the whole point. There is no hot hand. Like there are people who are skilled and people who are not. Now, some people's process is harder for them to articulate, but they still have a process, right? So, I think it's important that back to you, Alexandra, your question about like active versus passive. If you can identify an investor's process and then have like a kind of first principle understanding, like why should this process add value? So someone comes to you and says, "Hey, I trade futures. I have had a hot run of 2.5 years. Want to come in?" And the wrong way to do it, in my view, is like start thinking, well, 2.5 years, what were your returns? Oh, you had 23% per year over that time. Awesome. Where did I sign up? The right way is like, well, what makes it repeatable? Like, how did you know in advance that those were going to be winning investments? Like, what risk did you take? If things had gone the other way, how much would you have lost, right? So counterfactuals, even though counterfactuals are hard, but the world, especially in energy is a good example. Let's say there is 1,000 monkeys, and you split them 500, and one set of monkeys takes a levered bet in futures that the commodity price will go up. The other 500 monkeys takes the levered bet the energy will go down. What you don't want to have happen is one of the 500 monkeys who after the fact got lucky and was right, come to you and claim that they're a really skilled monkey because they're just still a monkey. They're not a skilled investor. So you got to be careful that you thought about the different paths the business or whatever the key variables could have taken, and how would the investor have done across multiple scenarios. Now, if they're really skilled at picking out the outcome, okay, but then I want to understand what makes them so skilled. It's something that most people can't really do, which is forecast commodity prices, including, by the way, I remember asking the CEO of Chevron or ConocoPhillips and CEO of Halliburton, and they say they have no idea. So, whenever someone thinks that they can figure out how to coin flip better or roll the dice, either they've loaded the dice or they're kidding themselves, is my view. But that's my biased opinion. Let's go back here. So thorough analysis. I was trying to go off of what you said, but like what's analysis is probably easy, but what's thorough? Yeah.
One thing that he said was that it would be justifiable both like quantitatively and
Okay.
qualitatively when you're looking at your stocks. So being able to justify both ends that like
Okay, so quantitative
whatever happens in the news
plus qualitative. Okay. But you can have quantitative and qualitative and still be shallow, right? You can still say, well, put a number on it, and I like the CEO's mustache, and boom, that's qualitative, quantitative, good to go. So how thorough? You had your hand up. I don't know if you want to talk about that. Well, I'll take anything. We can go with Jeopardy, and we can take a category here.
So I was just going to say what he just said, that it has to be both the quantitative and qualitative factors
You
that
get full
are
credit.
supporting.
No, and I think that's an important because I think a lot of times, just as an aside, people think of Graham as purely a quantitative investor, just numbers. Like you look at asset value, and that's not true. It's true that he's more numbers based than some other investment styles, but it's definitely not true that he's just looking at numbers. And I think, let's see, maybe one of you had a question. Let's see. Well, we'll come back to that. I think there was one. No, actually, no. The one of you pointed out, I think it was you. An investment operation is one that can be justified on both qualitative and quantitative grounds. I think it might have been in your write-up which you sent. So I think that's on page 107. So I think that's important to understand. So he's not saying just multiply some numbers together and it's all in the numbers. So thorough analysis. The thing is, there's no answer to that. Oh no, you have an answer. Never mind. You have an answer.
Well, internal and external factors of looking at the qualitative and quantitative.
Tell me more what you mean by internal and external.
So, for example, you mentioned or competitors. So when we're looking at or how individual trends, and even though I know they made thing in the book, it's not about trends, it's averages, but how preferences are changing and how that affects the company's role within their ecosystem.
Okay, so I think that makes sense. So there's definitely a type of analysis. I guess the part that I struggle with that I think is purposely open-ended is how thorough is not defined on purpose. Now, to some degree, this is the definition, right? I guess thorough means you read this and apply it. So maybe that's like what thorough means. But it's not very specific. So I think it's important to be thorough. But I guess maybe it's important that you within your process know why the analysis you perform is thorough for you. Now, it's subjective doesn't mean anything goes. Like again, if you say just the mustache thing, you like that's not, you can claim this thorough, but it's not. So I think there's wiggle room, and I think the point is that he's not trying to have a prescriptive, narrow way of doing things, like a formulaic approach. He's trying to create a framework and allow some degrees of freedom for how you're going to implement it. What does safety of principle mean? It's almost 3 o'clock. Yeah. Oh, yeah, some of you weren't here. So at 3 o'clock, I start calling. I have a mental heat map of the room. Green means I answered a lot of questions. Orange is in the middle, and I'll let you figure out what the red means. And so when it's red, I'm going to start after 3. The hard questions go to where it's red. But we have a few minutes. So safety of principle.
It's your initial investment. You don't want to just lose that.
Okay. Yeah, you don't want to lose your money. That's what I know. That's not a bad place to start. I guess another way to think about it is purchasing power, right? Let's say you have a high inflation environment like the 70s, right? You have $100. In 3 years, you still have $100, but the purchasing power of your $100 is greatly reduced. So I think you want to think not just. So I think you want to make sure you think in real terms. Is my interpretation. So it's safety of the purchasing power of the principal is how I would think. Yeah.
Professor, is there such a thing as like a value investor on margin? Because I know, for example,
he used margin. That's how I think he lost the 70%. Again, this is my understanding. This is not in the book, and that's my understanding from people who've studied other sources. Well, let's talk about margin quickly, and we can come back to it. But margin, what margin does, so the way margin works for those who doesn't know, you basically borrow some money against your security. So you have a security, and there are various margin requirements. Well, let's say you can borrow some like 30%. Let's say you have a $100 stock, and you go to your prime broker and say, give me $30 with that $100 stock as collateral at some interest rate. Let's say it's 5%. Why? You're going to go and invest that $30 into something else, maybe more of the same stock. I'll just say that. So now, your winning and losses and winnings get multiplied, right? Here's the problem. You can get a margin call. And what that means is, let's say your stock temporarily goes down from 100 to 80. Well, the margin requirement is the same. You can only borrow up to 30% of the collateral value. Now, 30% of 80 is less than 30% of 100. So if you borrowed up to your full capacity to borrow, the prime broker says, post some more money. Let's say you're fully committed. Presumably you borrowed so you could commit it into securities. You have to sell. So now you're in one of the biggest no-nos of value investing is you're a forced seller. Rather than picking your time, having time horizon be an advantage, because you can, it's not in secure analysis, but it's in Ben Graham's Intelligent Investor. He has this parable of Mr. Market. And for those of you who don't know, he says, well, imagine you own a business. You came in for $1,000 into a real business. And imagine that you have a partner, and his name is Mr. Market. And every day, that partner quotes your price for your $1,000 interest. But he's very manic. And some days he offers you a really high price that's very silly. And other days he offers you a really low price that's also equally silly in another direction. And most days he offers you kind of a reasonable price. Well, he says, if it were me, how would you deal with such a partner? Well, when you don't like the quote, you ignore it. You say, that's a funny offer, but I'm not going to take it. But occasionally, let's say he offers you a really fancy price for your interest in that business. Now you can transact with Mr. Market, with your partner, and have him buy you out. Conversely, other days he wants to sell you more of his interest in the business at a silly price. You can again transact, but it's your choice. The great insight into that in that parable is that you have the option, but not the obligation to transact, and you are not forced to be affected by what someone else prices your securities at. Just like if someone offered you a crazy price on your house, you probably would say, that's interesting, but I don't want to sell. But maybe if someone offered you 10x what it's worth, maybe you still wouldn't, but you probably at least think about it and talk to your significant other and say, if someone offered me whatever 10x, maybe we can buy 2 houses, whatever it is, right? So that's kind of very important. I think the reason it relates to your question about margin is that now the price matters in the moment. So the price locks in the value. One of the premises of value investing, and there are certainly other theories, as an asterisk, like George Soros has a theory of reflexivity. But in general, value investing kind of starts with the premise that for most situations, value and price are distinct, right? And that there's a price someone's willing to pay, and there's a value or range of values of that business or that security. And therefore, you're free to ignore the price as much as you want. However, margin can undo that, and it shrinks your time horizon because now you're not in the business of just answering what's the business worth. You're now also in the business of answering how is the stock or the bond or whatever instrument is going to trade. That's a much harder business to be in. So not to say that you can't do it in margin. I don't. I've structured my partnership in a way that by the partnership agreement I cannot use margin. Not that I'm tempted, but for the avoidance of doubt, and it's for that reason. Your time horizon shrinks and you can be a forced seller, and then you can be right in the long term but still be wrong in terms of your outcome. All right, so safety of principle, I think it's not that hard, but which, by the way, is the alternative view is people talk about volatility. So you can tell a lot of, so if someone uses a lot of, there's a statistical risk management software called Barra. So if someone uses a lot of Barra speak, which is like words like tracking error or drawdown or, don't worry about what those are. You know that they're not thinking about risk as losing money or losing your purchasing power. They're thinking of risk as how is your portfolio going to gyrate in the market, in the short term. And that's what most people don't care. I mean, yeah, sure, they don't want to lose all their money. That's a given. But they're thinking about if Mr. Market, transacts with someone else at a really crazy price, they get affected because they go to their boss, the chief investment officer or whoever, or their client, if they are the chief investment officer, and they say, well, what's going on? You, on paper, looks like you lost 17%, or, and maybe the client takes out the money, or maybe the boss fires them before they can come back. So they're worried. Remember last time I talked about the money game, the famous kind of identity, anxiety, money. So not only is it going to affect their money potentially, but now that 17% paper loss can impact their kind of self-identity because they're anxious that, hey, I'm a great investor, but I have this, on paper loss that maybe I'm not great, right? So, so I think to the degree that you can structure yourself to focus on this as your kind of measure of risk, you have an advantage. And things like that matter for that is, for instance, having the right clients. If you have clients who think of risk differently than you do, and they call you every week and say, hey, how are you doing this week? Are you back up yet? That starts to put pressure on you. You can't help but start thinking, oh, gee, when am I going to get up, back up? And there's no way to know. Like Mr. Market, you don't know when Mr. Market is going to offer you a fancy price or not. What's a satisfactory return?
So the way you quantify is if you quantify risk through safety of principle, would you be talking about margin of safety? Is that the
Well, safety of principle is a goal, right? That's, so it's a goal, we define risk as not losing our purchasing power, right? Margin of safety is a means of achieving that goal. It's having a big enough spread between what your estimate of value is and your actual price so that you can be wrong on a number of your assumptions if you use in estimating that value and still do okay, or at least not lose very much. So goal versus methodology of achieving that goal. Does that make sense? What's a satisfactory return?
Just varies. So
Varies.
particularly
So
like satisfactory.
1% okay?
Could be. I mean,
Well,
if everybody
1%.
else got negative 20.
Okay.
do 1%.
Okay. So that's an important question. So let's talk about this. So absolute versus relative. So you kind of touched on an important point. So in the mutual fund world, where I started at Fidelity, everyone is paid pretty much on relative performance. Why is that? I have a theory. So first of all, most people, interestingly enough, aren't even paid against the benchmark. So do they beat investing with a passive index. They're paid mostly on relative to their peer group. So first of all, here's a little math. If 80% plus of mutual fund managers underperform the index over the long term, do you want to be compared to the index or to the peer group? It's a kind of obvious answer. You want the peer group because the peer group is easier, right? So let's pick a peer group. Second of all, there's kind of people naturally have this herd instinct. They want to own well-known companies because they don't want to be blamed for doing poorly unconventionally. If they're gonna fail, it's okay to fail by owning IBM or these days Amazon, right? Because whatever, Facebook. But if you own some little unknown security no one's heard of and you fail that way, what were you doing? And GE is a good recent example because for the last 15, 20 years, everyone owned GE until a couple of years ago when the stock imploded. I'm not saying that it's a bad investment, but I know even back in the Fidelity days, it was considered one of those blue chips, must own, big part of the benchmark, safe, everyone owns it, right? So this relative returns, the problem with them is that you can't eat them. You can't spend the relative return. So if you're if you're zero and everyone else is minus 20, maybe it says something, maybe it doesn't, but you can't spend it, right? And I think part of what you're trying to accomplish is you're trying to increase the real purchasing power of your or someone else's assets. So if you're managing money for a family or a foundation or endowment, you're trying to help them achieve their goals, right? And in the short term, it's true that relative return, you can look at it and say, okay, there's some information there. But I think that when people have a relative return orientation, this is my theory, I don't have proof, but it's just kind of observation, is their absolute returns are actually worse. And when people are focused on absolute returns, over time, their relative returns are better. Now, why? Because I think when they're focused on the relative returns in the short term, they're afraid to be different. Back to your question, Kelsey, it's, they go back and they don't look at those spin-offs, those unknown, companies, or the stock term hates, because they're afraid that they're going to be different and they're going to get fired, or their bonus will only be 1 million instead of 2. Horror of horrors, right? You won't believe. I think it's actually not the size of the bonus; it's their ego that they're worried about. But losing that extra million will really hurt their, standing in the country club or whatever, right? But the point I'm trying to make is, I think you become a worse investor if you start constructing your portfolio with relative returns in mind. Over the long term, obviously you need to exceed your opportunity cost. So obviously, if you invest for 10 or 15 years and you haven't exceeded what a passive investor could do in an index fund, and you should have done something different probably with your time. So I think the point is he's not defining satisfactory return on purpose. I think there's, it might be a function of your environment, might be a function of your preferences, but there's probably some range. In my mind, should be well north of inflation. How much? I don't think there's a right answer. So the most interesting thing to me, because I've done this, I use this material to mentor many, many people, and only actually halfway through that I always used to focus on those 3 things. Why do you think he says investment operation? So he doesn't define an investment is, boom, boom, boom. He says an investment operation is one that upon thorough analysis, blah, 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 blah. So why investment operation?
I was going to say, is that the process that we were alluding to earlier? It's about, what's your process versus is it outcome based?
It could be. I guess I had a different interpretation, yeah?
So he talks a little bit about that in the book, and I think it's not about the stock itself, that there's some peripheral issues that needs to be taken into account. For example, the price versus, the price range. It might be different at one price and unattractive at another price, for example.
Okay, all right, so yeah?
Could that be fees and the mechanisms for actually purchasing the asset?
It could be, but although you could probably include it in the price and then you can net out that. Other thoughts? Yeah?
Could it be the type of security, whether it's like a junior bond or like a preferred stock, or that type of thing?
It could be, but you could still define an investment, in a security. Like investment in security is one, which upon thorough analysis offers safety of principal and satisfactory returns. So I have a, oh no, I don't keep taking insights.
I was just saying, like, an investment operation is different from an investment, because anybody can make an investment, but not anybody will go through an investment operation, in which, like, you kind of do all the components that we talked about, and then make your choice.
Yeah, I think there's that, and so you kind of interpreting operations as more process as opposed to a decision. Interesting. I didn't think of it that way. It could be. So to me, what I think he's talking about, at least, is two things. So investment operation doesn't refer to one security; it refers to many securities, and also the act over time of buying groups of securities, right? So when I think of investment operation, I think of he managed an investment partnership, kind of. I manage an investment partnership. He so any given point in time, you own some N securities. Maybe it's 5, maybe it's 100, depending on parameters, right? And then also over time, your securities change. So to me, he is defining this not with respect to a single security or a single decision, but you have diversification at a point in time and over time. And so, and the question I have, I wish I could ask him, but he's dead, so we won't know, is can a single decision, not a single outcome, but a single decision be considered an investment decision or a speculative decision? Or does it always have to be in the context of a portfolio or even a portfolio that moves over time, right? I don't know, what do you guys think? Yes, past 3 o'clock.
Can you repeat it, the question?
Sure. So basically, can a single investment decision be thought of as speculative versus a kind of investment base? Or does it always have to be in the context of a group of decisions, a portfolio?
I would say it has to always be a portfolio because, like in the speculation, is like you said before, it was a bet. So it's kind of like serious, like really risky to put a lot of money on a bet. Well, that's why you go to gambling or to like casino. You go and bet for fun, but in here it's actually work.
All right. Also, can a portfolio of speculative securities be an investment operation? And the reason I ask, so there's a style thing, so there's 2 types of value investors. Some value investors say, we want every single security to have very minimum downside because we like safety of principle. We achieve safety of principle by making sure we can't lose very much on any single investment. There's another school of thought saying, you know what? If I have various independent investment, bets or decisions where maybe the risk reward is 5-1, but it's 100% down and 500 up, and they're truly independent, but their expected value is very positive, I'm fine taking on independent bets where you can lose all your money because at the portfolio level, I'm going to be diversified enough that I'm going to do very well. And that's a different approach. So remember, last time we talked about dimensions of an investment style, kind of things that define an investment process and that allow you to basically have, orthogonal, independent axes of like, where are you on this? So I would say that's an axis of how do you manage risk. The broader parameters, how do you think of managing risk? Specifically is it, can you have somewhat speculative, and speculative may be the wrong term because I don't want to imply that just because something can go to 0, you don't do thorough analysis. You could have done very thorough analysis and that's what allows you to determine that the risk reward is very favorable and the expected return is very high, but you could lose all your money. So, so I think that's something to think about. I don't want to. Yeah.
Maybe is the answer like it would relate to like a confidence interval. There's a certain amount of certainty you may have based on your results over time.
Yeah. No, I think that's right. I think value is always a range. I think that. So I think it's actually right to think of that range as a confidence interval. Like I'm 90% certain that value is between X and Y or something like that, right? That's without doubt. But for instance, like should every single investment in your portfolio have that lower bound of the confidence interval be a certain no more than X? I can't lose more than 20% of any of my positions in the portfolio. Or do you say, hey, doesn't matter because I'm diversified, expected return is high, it's gonna, over time, my outcome will converge on that expected return. I'm fine accepting some complete losses because, I'm drawing from a distribution that can produce spectacular winners. Which, by the way, so think about VC investing, right? not the topic of what we're talking about. But so venture capital investing is drawing from the distribution where you're going to have complete wipeouts, but you're going to have spectacular winners, right? The Amazons of the world. So you're drawing from it's called the power law distribution. Yeah.
And would that train of thought make sense most when you're investing in individual stocks versus indexes or what we were talking about?
Well, an index, by definition,
It's a whole bunch.
is more than one stock, right? So there's diversification built in. However, there's some really poorly constructed like ETFs and indices, right? There's some of them are triple levered, and you can actually lose all your money in an index. Like there's thousands of ETFs now, like because people, it's a business, people slice and dice it in all kinds of ways, and you can find ones that are constructed in a way that use leverage, that you could totally lose everything, because the volatility, if it wiggles this way and not that way, you'll get wiped out. You get zero. So there are ETFs like that. ETFs being an exchange traded fund, which is kind of another version of an index these days. But I think in the sense, so it is applicable in that sense. So because you could put together a portfolio of ETFs, right? And let's say you want to have passive exposure to biotech and energy and this and that. That's not how I invest, but I'm saying you think that way and you pick the wrong ones, you could lose a lot of money. Now, probably your outcome is going to be less extreme than if you pick an individual security in one of those sectors, right? Because you're just going to get the diversification of a group of securities. But you're not going to avoid the fact that you can still do pretty poorly. So I don't know if it's necessary. I think it applies both. I think it applies more to security analysis of individual securities. But I think that unless you're talking about just very broad indices, unlevered like S&P 500, then no. By the way, and I can send you guys the chart of rolling 10 years returns. There are 10-year periods where people lose money investing in index funds, because I think what people, there's this mistaken notion that, well, the index long-term return is X, and X is 8 to 10% or nominally over some very 100 years, right? And people say, well, if I invest, then I get 9%, right? That's kind of the mentality. Well, maybe if it's like if you take 100-year periods, maybe that's true. But even over periods long enough as 10, 15 years. So let's say you have children and your time horizon is college education, and you have money you're investing for, 15 years from now. That's a long time horizon, or 10 years from now. That's a good example, because maybe your kids are halfway through they're half the distance to being in college, they're 9 or whatever, right? And you have another 8, 9, 10 years left. Certainly a long period of time. You can invest in the broad S&P 500 index and lose money over time. That's not the most common outcome, but it's certainly well within. Like if you look at rolling 10-year periods, so I think which by the way, dollar cost averaging. Do you want me to explain what dollar cost averaging is?
I do not know.
Okay, so dollar cost averaging is, let's say you save $100 a month, and rather than putting all your money at one point in time in an index fund, you buy it. Every month you buy $100.
Oh, at the same time.
Same amount per period. So you're keeping the investment per period constant. You're not listening to the talking heads on CNBC or what Jim Cramer and Mad Money says you should do. You're not worrying about who tweeted what. You're just saying, I have a strategy. I'm going to get an average price through time by spreading out my amounts into equal chunks, and I'm going to buy one chunk per period, irrespective of whether the prices are high or low. So now you're buying something that's diversified, already an index, but now you're getting diversification over time, and that allows you kind of to avoid that scenario where you put all your money in at a very unfavorable price for the market. That's not always feasible. So that's feasible if you're kind of a working person and you have a steady stream of income and you're saving from that. But what if you get an inheritance? Or what if you have a large bonus? There are a lot of situations where you have a lump sum that you need to invest. Like let's say you're an entrepreneur and you sold a business. I have one of my partners. He was a classmate at MIT. He sold a business for a 7-figure amount. Like, what do? Because you have, someone's going to give you the check. It's sitting in the bank. So you can maybe spread it out, but if you're spreading it out, essentially you're investing at very low rates in the bank until you fully deploy it. So it's one of the things I think you'll see is that there's always more nuance to a decision than it seems with this. So even something as simple as I'm going to index, do you go all in once or not? Which index? There are many indices. So I would say I think the idea is general enough that it applies to everything. So I think that, and then how it's implemented would be different for maybe an individual security versus an index. That's how I would. Does that answer your question?
Yeah.
There was a question people asked on page 86. One of you asked, I think, about the future, and so I thought it was a very pertinent question. So I think they were talking about, needless to say, kind of 2/3 of the way down on page 86. Needless to say, the analyst must take possible future changes into account, but his primary aim is not so much to profit from them as to guard against them. Broadly speaking, he views the business future as a hazard, which his conclusions must encounter rather than as a source of his vindication. So this is a common topic. When people think about value investing, they think of it as not focused on the future. So it's focused on the past. So I want to talk about, I'll kind of give you my thoughts, and then we can, certainly have a discussion. But I think, remember that value equals the net present value of future cash flows plus excess assets. And that is always true. Now, the specifics vary. So it's future cash flows that matter, right? And it's also the realized value in the future of the assets that matter. The reason I'm saying that is that value investing, growth investing, any kind of investing, you're always thinking about the future. The difference, I would say, is that in here, remember he says, future is something to be guarded against. Why is that? It's because his style is based on having a future business outcomes that are both based on the past and are somewhat resembling the past. So he's not looking for this time is different, like a newfangled business model that's never been done before. He's not trying to find an early stage biotech that's going to cure cancer. Or, he's looking for businesses that have a long history, that we know what they're going to be, what they have done, and now we have reason to believe that the future is not going to be altogether different. And that's why we're guarding against that. We're guarding against some change, some obsolescence, like we go from horse carriages to cars, right? So that would be kind of a perfect example what you're guarding against. You're sitting there, you have a 20-year history of this horse buggy with a business with free cash flow, and you extrapolate that into the future. But Mr. Ford has a different idea. He has his Model T, and he's going to price it low, and people are going to switch. So obsolescence or a substitution, things like that. That's, by the way, why qualitative analysis, bringing it back to that point, is important. So it's not enough to just say the average was this, the average was that. You have to have a qualitative reason from first principles to think basically, hey, there's a reason for this average to either reoccur or to be at least approximately predictive of the future. So that was a question one of you asked. I wanted to address. I don't know. Other questions? Yeah?
So when you say excess assets, do you mean assets other than cash?
No, what I mean is assets that are not used to generate the free cash flow. Because again, the example I like to give is, let's say you have a factory that makes widgets, and it costs you $100 to build the factory, and that factory makes $10 of profit every year. And then that company happened to raise $110 because it wasn't sure how much it was going to cost it to build the factory. So now it has $10 in the bank, and it has a factory which costed $100 to build. So it has a property, plant, and equipment entry in the balance sheet that has a historical cost of $100. Well, the value of that business is the net present value of those cash flows, that 10 plus 10 plus 10% discounted at whatever discount rate, plus that $10 that's extra. That's not, but it's not, you can't double count the 100. That's the important point. The $100 that was invested into the factory. You can't say Well, they have $110 of assets, plus they have the stream of cash flow, and I'm going to have $10 per year. I'm going to take the net present value of that, because now you're double counting. And the reason is you have to think as a business owner, if you were to buy the whole business, you could dividend yourself the $10, walk away with that and spend it, and still have the cash flow stream at $10 a year. I want to do a quick, since we're at the end of the half an hour mark, I usually stay late, or at least I'm always willing to stay late. So kind of as a prelude, we're not going to dive into any 10Ks or 10Qs, but since I brought my golden book here, we're going to use it as an experience. So use this as a proxy for an asset, right? It could be a business that has inventory, and this happens to be inventory and trying to value it. So I'll tell you what this is. This is this is basically the same sixth edition you guys have, used by me, and it's if you like it, nicer bounding, and I don't know if it's real gold or not, but gold colored, kind of playing, and it has a nice little bookmark, which I haven't been using. I've been using all kinds of paper. So if you guys, and so we're gonna take a little. So what I want you to do is, I want you to write down a number or think of a number, but I don't want you to change the answer based on I don't want some anchoring on the first person who goes. Don't look it up on eBay. We'll do that later. What do you think the current value is of this book? Or the current value? I'll be more specific. What do you think the current resale value is? Like if we were to sell it or to buy it, what would it be? So let's think of a number. Write down a number. I'm going to trust you to be intellectually honest, and then we're going to get a range of intrinsic value for my book. Caveat is if you give me a really good offer, I might sell this to you. So
resell it, so it'd be like a second.
Yeah, it's my book. It's
Which edition? Special edition? Or?
Yeah, special edition. It's a 6th edition, but special, gold plated. There's a nice, I'm getting my marketing, I kind of like it, so I'm not sure I'm prepared to part with it unless you offer me a really good price, and I'll be the judge of that. I don't think I'm allowed to take actual money from students, so don't worry. But pretend I were. Pretend like if you whatever number you said, pretend it's not real, but that I would be willing to transact with you if you do something crazy. Try to keep you focused. So who wants to go first? You're all gonna go, so don't worry.
I guess $25.
Ouch. Ouch. $25. Yes.
150.
Sorry?
150.
150. Okay. Here we go. Don't change your numbers. Yes. Let's keep going.
I said $2.99, but now I want to say $1.99.
No. I appreciate intellectual honesty. $2.99. I'm gonna start wrapping it up for you. Yeah.
85.
85. Yeah.
45.
45. Oof. Not striking a deal with you today. Or you have 5x to offer.
34.50.
34.50. This is kind of like the Price is Right. We're gonna get.
Yeah, Amazon.
I don't know, what's the cost of the regular edition? I think it could be.
Okay. Thorough analysis. Right. Okay. What's the cost of a regular edition? Can someone please look it up? Actually, no.
$31.99.
$31.99. So now we have a data point. So that I like that because you asked the question. That's totally allowed. At $31.99.
So maybe I would say $60.
$60. Okay. So okay.
Can we all, now knowing that,
You want to get the benefit of his thorough analysis. Free writing. Okay. It's okay. We can go again, but I want to finish the first round.
75.
75. Okay. 75. Who didn't go? Everyone won? Yeah, you're allowed. Do you have a guess?
I know the answer, so.
Oh, you know the answer. You want to go? Just for fun?
Book.
Yeah, for fun. You don't have to. I don't want to put you in the spot. 63. Okay. So I think, and you guys can go again if you want. So a couple of observations. One is we have a 10x range, right? 25 to 299, which by the way is a simple book. Think about valuing a business, right? So this is a book. It's a little bit unusual. You could have asked a bunch of questions. It happens to be there's what are some questions you could have asked? What is comparable? Something that's somewhat clearly known to be inferior. You could have also asked how worn is it? Does Gary like to highlight the heck out of everything? And is that good or bad? Did Seth Klarman autographed this book. He did not, but right. So there's a bunch of things you could have asked about it if you were more thorough. That's okay. The reason I'm using this as an example is because it's something we wouldn't expect a lot of variance. We kind of should all agree on what the number is, but a priori we disagree. We also disagree about what thorough means. And I'm using this as an example because I think as you go and you look at actual businesses or examples or whatnot, first of all, there's no right answer, except here, because one of you is going to do me a favor and go on Amazon or eBay and tell me the answer. But in general, it's hard. Like, let's say you're liquidating a business, you're liquidating a retailer, and you say, okay, value equals net present value of free cash flow plus excess assets, and it's just liquidation. Your theory is they have $100 of assets, the stock is trading at 60. Well, assets is defined by whom? By historical cost. Now you're trying to estimate what will I get, still in the future. And if we can't agree on the book, like how are we going to agree on a retailer with 10,000 SKUs? How much is obsolete? How much is already being sold by competitors at a lower price, right, than they paid for it, right? Because time has passed. So remember, it's always a range. And now, can we get two numbers, an eBay number and an Amazon number? I see a lot of laptops.
Amazon is
Amazon's 194.98 if new.
What about gently used by Gary condition?
105.99.
Whew. I just erased like $95 off the book. All right, so, okay, what about eBay? Do we have an eBay number? I did this in last year's class, and eBay gave me a vastly different number, so I was a little bit taken aback. Which made me think about arbitrage. Maybe we could be buying on one. But, yeah. Any eBay estimates? All right.
And one for like $8.45, but that's the second edition.
No. It has to be special golden fancy schmancy. 6. All right, we can. But so the interesting thing is we got the real price is probably somewhere between 100 and 200, right? So called 150 according to Amazon. The good news is we bracketed that. Like so our range includes the real value. That's always important. Like if the value were 10 or 500, we would be like, ooh, we didn't even have it in the range. But it's
It says 40,000 the special edition.
$40.
$40,000.
Well, maybe that was signed by someone. I don't know. Or maybe that's the offer, but there's no volume with that.
It says one out of 1,000 copies, so it's probably a limited edition. I don't know if it's the same one.
I'm not sure, but would you be interested in buying this for 40? Because we can. I will talk. We can get exemptions for these transaction rules. Yeah.
Is this getting at to because one of the ways I kind of began to see intrinsic value, and I talked about this in evaluation class, where there's a difference between valuation and pricing.
Sure.
And so, like for example, to the example, there's also the Seth Kravman book, Margin of Safety.
Right, that goes for $3,000.
Yeah. No, and I've seen it. I think it's $3,000 plus.
Yeah.
Because like when he published it, no one cared, and then afterwards it gained traction.
It's out of print. I have no idea. Like I've read it. I'm not. This is no way. I don't understand why it's at that price. Let's put it that way. Certainly a good book, but it's not fundamentally more valuable than a number of other books on the list. I use it in later on, but I think scarcity, supply, demand. Also, there is a fame associated, right? He has now become since then a very well-known, wealthy individual, very successful, and there's a very limited supply. So perhaps that. So this maybe gets into the collectible aspect of it, versus this is not collectible. There's a little bit. I mean, it's like nicer, so it's prettier, but it's not collectible in the sense that I didn't say this is again if this were signed by someone. Well, so I mean. I'm happy to stay and answer questions. I know we're over a lot of time, so I know people want to get to getting a drink of their choice, whether it be tea, coffee, or something stronger. But I'm available. I can stay. But next week there's no class. The following week, I'm going to give you a dense assignment. It's going to be part 2, which is the fixed income part. They're going to be actual examples to try to work through. And I guess one thing I'll encourage you, it's not for credit. I'm not going to grade the assignments. I do read what you send, and you're going to get more out of it if you engage with the material more and less if you don't. And that's okay because everyone has different goals and they have different reasons for being in the class, you know. But to the degree that you have the time, if you can do them, you will understand the material so much better because it's really not a spectator sport. It's not something like where you sit and you kind of absorb it by osmosis and, you know, and then you like, wow, I know how to value invest and I could actually do it. So remember, like you gotta, you know, do these things, and probably a good thing we have 2 weeks for you guys because part one was easy. It was all kind of conceptual. It's nice. You could probably have part one as a beach book. You kind of read on the beach. Part two is definitely a little bit denser than that. So happy to questions that I didn't answer or let you guys go.
Thank you. Have a good weekend.